Good morning. I'm Kevin Orr, and I head up strategic partnerships at Crane Shares. On behalf of my colleagues at Crane Shares and our partners at Man Group, I want to thank you for joining us for today's webinar called Harnessing the Key Drivers Powering Private Equity Buyout Funds Through Public Equity. This is the basis of the Crane Shares Man Buyout Beta Index ETF. That's a mouthful. Ticker BUYO, Buyout. With me today is John Liddington. John is a partner and managing director at Man Group and is co-portfolio manager of the strategy. Man serves as the index provider and the sub-advisor for the Buyout ETF. For those that aren't familiar with Crane Shares, we are a specialist asset manager that seeks to provide innovative, high conviction, and first-to-market strategies in three key market segments: China and emerging markets, climate, and alternatives. Some background on Man Group. Man is a preeminent global alternative investment management firm that manages approximately 178 billion in assets under management, with an underpinning of deep research and talent across both public and private markets across all major asset classes. Before we get started, a few housekeeping items. We are live streaming the event on our website. Any questions, please send to info@craneshares.com. If joining via the Zoom link, please submit questions via the Q&A button on the bottom of the screen. We'll try and get to as many questions as possible through the course of the presentation, particularly at the end. We're also offering one CE credit for CEMA and CFP holders. Please request this through ce@craneshares.com. With that, let's get into it. I'll pass the baton to John.
Great. Thank you for that introduction, Kevin. So as a firm that's active in many asset classes, as Kevin mentioned, both alternative and traditional asset classes, at Man Group, we spend countless hours thinking about clients' portfolios and how our various strategies might be able to help them achieve their investment goals. And oftentimes this includes creating custom strategies or launching brand new concepts. One example of this is what we call liquid private equity, which is the precursor to the Buyout Beta Index that we're going to be discussing today, or really the foundation that index is built on. So we originally designed the liquid private equity strategy back in 2018 to help a public pension plan with cash management within their PE allocation. This client or this prospect had viewed liquid private equity primarily as something they could invest in while ramping up their private equity allocation and also manage their committed capital as they waited for it to be called by the private equity funds. So they were looking for something more nuanced than a passive public equity index exposure like the S&P 500 or Russell 2000, or something that was a closer fit for the returns they expected from their PE book. And very importantly, a product that matched the real underlying drivers of that return, not just the private equity return itself. So our original research started with deconstructing what it is that drives private equity returns, specifically buyout returns, as buyouts are the largest segment within private equity and the segment with arguably the most conceptual overlap with companies that are publicly listed. And I'm going to use those terms kind of interchangeably here today, private equity and buyouts, but just know that we are targeting buyouts specifically. So at a high level, we knew that buyout funds look for undervalued assets with very specific characteristics that allow them to take on a significant amount of debt in these deals. But to go deeper than that, what we did was actually lean on academic research, including a paper out of Harvard Business School that was based on a survey in which the authors, the professors at HBS, went directly to PE general partners and asked them what they do to add value and ultimately generate returns. And there were 79 respondents in that survey, totaling over 750 billion in assets under management at the time of the paper back in 2015. So pretty representative sample, I'd say. So we'll get into the specifics, the specific PE characteristics that we look to mimic in a few minutes. But this gives you a very quick background on why we decided to create a beta of sorts for buyout funds and how we approach this at a high level. So while this endeavor started off with more of an institutional use case, the fact is the traditional private equity industry has begun setting its sight on the wealth market for the past few years. And although it's early days, I'd say not all Main Street investors have access right now to some of those private equity offerings. So this index is designed to provide exposures to the drivers of those PE returns as PE begins to make its way into asset allocation plans for wealth clients. So this all started with kind of a concept of a buyout beta. That concept has always intrigued us at Man Group. As I'm sure you know, many other major asset classes have some form of of investable beta that allows investors to gain broad exposure to the asset class, typically at a more cost-efficient price point. Now, getting efficient exposure to those betas, or in other words, the returns of the broad market or the asset class that you're looking to gain exposure to, gives investors more flexibility to then allocate to alpha-seeking managers that look to outperform within each of those asset classes. Now, being a long-only asset class, one might hope for the same with private equity, but the fact is private equity historically didn't really have proper investable beta, which is where we come in, and we're happy to say that's no longer the case. So let's start with the fact that there's a 75% correlation between the total returns of buyouts and the public equity market, depending on which indices you're using for each. And so publicly listed companies naturally seem like a good place to start if you're trying to create a beta exposure for buyout funds. Now, that said, at the foundation of the case for buyouts, traditional buyouts, is the clear expectation that these funds should outperform the public equity markets. Now, a lot's been written about what percent of PE managers actually achieve that baseline expectation of consistently outperforming public stocks, but we can put that debate aside for now and address it another day. Because outperformance of public equities is a baseline expectation for accepting the illiquidity and the long lockup of capital in a PE fund, we made it a critical goal to have this buyout beta outperform the public equity market, but importantly, to do so with return drivers that are as similar as possible to those of buyout funds. So if we could move on to the next slide here, Joe. So start to get into the meat of it a little bit. So this starts with making sure that we are fishing in the right pond. I won't go through this slide line by line. There's a lot of text, but and we'll be coming back to some of the details in a few minutes. But in short, we want to make sure we're buying companies that are roughly the same size and in the same industries as those found in buyout portfolios. This exposes our portfolio to many of the same top-down tailwinds and headwinds as PE funds. For example, if a strong housing market is going to be a tailwind for a PE-owned building supply company, it will very likely provide a very similar tailwind for a publicly listed building supply company. Those are the exposures we're looking to match industry by industry. Now, starting with this pool of companies in the same industries and of a similar size to PE portfolio companies, we then systematically narrow down the universe to really focus on companies that also have similar bottom-up or company-specific characteristics as PE holdings. And then we ultimately build an index containing these publicly listed companies. So that's what we're going to be talking about today. That's referred to as the Man Buyout Beta Index. So next. And before we dive in fully, we can just maybe get a quick lay of the land of the buyout industry just to provide a bit of context. So in this short amount of time, we're not going to be able to really do it justice, but first, why have buyout funds been so popular with investors? As noted, the strong historical returns are reason number one. And then a distant second, in our opinion, is the potential diversification the PE offers. So analyzing these two purported benefits, first, the historical returns of PE have indeed been strong, which has drawn a lot of attention to the asset class. But usually the return argument has centered around outperformance of passive exposure to a mainstream core public equity index like the S&P 500 or the Russell 2000, or maybe the MSCI World or MSCI ACWI if you're looking at a global PE portfolio. Now, of course, these comparisons do not take into account the nuances of PE portfolios like the higher leverage that helps amplify PE's returns. But more importantly, the headlines always focus on performance comparisons of PE versus one of these passive indices, not versus the actively managed public equity portfolios that are also able to consistently generate positive alpha over the multi-year time horizons that PE invests in. But putting those quibbles aside, a certain percentage of PE managers have historically generated returns that are sufficiently attractive to garner attention from investors. And frankly, they've caught our attention too, so we wouldn't be wasting our time mimicking the return profile of PE if we expected to continually underperform public equities going forward. So there's a baseline expectation of outperformance there for the asset class. But now onto the second leg of the stool, which is diversification. In our opinion, the diversification argument is a little shakier, given that the same macroeconomic headwinds and tailwinds, and then the industry-specific headwinds and tailwinds impact many similar companies in very similar ways, regardless of whether they're publicly listed or PE owned. At the end of the day, both the private equity investor and the public equity investor are taking ownership stakes in what are often highly correlated companies, as in our building supply company example, and frankly, countless other examples. Now, in order to access these benefits that investors expect from their PE allocations, which we've outlined on the slide, there are trade-offs. So, for example, there are substantially higher fees for private equity, and from time to time, investors are paying carry or performance fees on total returns that can be largely driven by market-wide tailwinds rather than any kind of true idiosyncratic PE manager alpha. And in addition, it can take a while for committed capital to get deployed by the PE funds, particularly in higher interest rate environments. Furthermore, PE is an illiquid asset class in which investor money is typically locked up for years, often more than a decade. And this is related to the cyclicality of distributions that we note here, the cash distributions thrown off by a PE portfolio. And that cyclicality is a pain that's been felt by many investors and PE funds in recent years, as we've had a massive slowdown in the exit environment for PE holdings over the last couple of years. Next. So this lack of exits is reflected in the stubbornly high level of dry powder that we see in private equity right now. Or in other words, the amount of capital that's earmarked for PE deals, but is still sitting on the sidelines. And by the way, not earning PE type returns for their clients during the time that it's sitting there. So I've seen various estimates of this dollar figure but almost all, I'd say, are over $1 trillion. So without getting hung up on the exact number, I think the trend is clear. You can see it here in this chart. PE fundraising has been strong for years now, but PE deal making hasn't really been able to keep up in the last few years, and even before the increase in interest rate of the last couple of years. But the bottom line is there's a lot of money in PE that is actively looking for deals. So that's what brings me to the other chart that we have here on the right. So it's somewhat of a side point that we could come back to, but it is worth pointing out that a portion of this ever-increasing war chest of PE capital is making its way into these public to private takeout deals, particularly in the last 3 or 4 years or so. And this is notable because as a result of fishing in the right pond, we've been very well positioned to reap the benefits of a number of our publicly listed equity holdings getting taken out. Next. So now we can dig into our approach a bit. So first we'll take a look at the types of companies that buyout funds tend to gravitate towards, they tend to buy. I mentioned before that they tend to be smaller in size and cheaper, with a very specific set of valuation metrics that buyout managers tend to target. Now, because these deals are going to be loaded up with debt, it's important that those target companies are profitable, as well as very disciplined and efficient in how they manage their cash. Otherwise, lining up the debt financing is going to be very difficult or potentially impossible at some points in the cycle. In addition, buyout funds are looking for companies that are growing or have the potential for significant growth, or at the very least, PE managers will typically be avoiding companies with significantly negative growth rates. Those are very unlikely to be takeover targets. Now, it just so happens that a number of the company characteristics that we've outlined on this slide are known to be alpha generative in public markets as well. So some of these building blocks kind of form the critical components of matching PE's return, which is our ultimate goal. But in the process of matching PE's key exposures, not everything we use in constructing this index is a known alpha exposure. Some are included merely to tilt the portfolio to more closely match PE in terms of its risk exposures. Next. So on this next slide, we'll go into a bit more detail on the key return drivers that I think any good PE manager should be employing to improve returns. Doesn't mean everybody does all of these, but a good PE manager should have a number of these incorporated into its process. So at the top, you have beta. Given that there's a common mutual beta with publicly listed companies, one can look at that correlation number that I mentioned before as an indication that a very healthy percentage of buyout returns can arguably be explained by this shared beta. I mentioned the 75% correlation before. Maybe that's a number you can keep in mind. But realistically, that I guess, given the PE itself uses public comps to help value its assets, I don't think that seems like that big of a leap. So again, if you're starting in an appropriate place by using a public equity portfolio to create this buyout beta, that still leaves a healthy amount of PE return that needs more than just beta to match. So fortunately, a lot of these key sources of additional return are replicable in the public markets. And these replicable alpha sources are shown in dark blue here. And that's where I'm going to spend a few minutes, the next few minutes, because this is kind of the crux of what we're looking to match and ultimately what transforms our index into a buyout mimicking portfolio. So going top to bottom, we'll start with leverage here. Leverage in this case means the debt put on a company's balance sheet at the outset of a buyout deal. It's a critical component of PE's total return. So right out of the gate, you want to make sure any mimicking portfolio that we're going to create is investing in companies that have the ability, demonstrated ability to actually take on debt. Now, next up is industry selection. I kind of alluded to this before, but this is a very important part of PE's returns as well, and the returns of our index. So I think good PE managers should be doing their homework on the industries that they're targeting, they're investing in, make sure they're ones that they want to remain invested in for many years, in some cases, often more than a full market cycle. And fortunately, these, piggybacking on these insights that you're gleaning from where PE invests in terms of industries is actually, it's relatively easy for us to kind of piggyback on the work that they do and tilt the portfolio to attractive industries and away from unattractive industries. Now, one thing that's important to point out is that these industry preferences do evolve over time. PE investors will, certainly change their industry preferences as we work our way through a cycle. So it's important for those exposures in the index to not just be static. They should evolve as PE's tastes or preferences evolve. Now, going down to the next line, valuation. I think this one's pretty self-explanatory. I alluded to it earlier, where PE managers are certainly looking to identify undervalued assets where they can then unlock that value over the course of their holding period. I mentioned a couple of these in passing as well, but you're looking for growing PE managers are looking for growing companies with more of a focus on the top line, specifically revenue that's increasing over time, looking for efficient cash management, looking for companies that are profitable, because again, you're going to need to pay down pretty heavy debt loads in many cases, and then looking for stability in that company. So, it can't be a company that's overly cyclical. You need to have some kind of visibility and predictability of key fundamentals, whether that be cash flow and many other metrics, indicating the company is stable and kind of investment worthy and credit worthy. And then corporate relationships, just going again in order, corporate relationships, we actually use a set of systematic signals that kind of analyze trends that are percolating within a company's broader network. So be that customers, competitors, partners, kind of mapping out the whole supply chain and kind of mimicking exactly what you expect a good traditional private equity manager to do as they do a deep dive on a potential takeover target. They're going to be talking to all these related companies as well as part of their due diligence. And then the last one is, just kind of simple. It's more just what's your starting point for the universe in terms of size. I know there are other kind of different approaches to liquid private equity out there where you'll have a very large cap portfolio. In our case, we think it's very important to actually match the company size that you're going to get in a private equity portfolio because it does expose you to some kind of top-down influences so that you have that commonality of impact. So again, we use the Russell 2500 as our starting point here before applying a number of kind of tailoring measures to get to our ultimate index. And then there are admittedly a few different sources of alpha that are not easily replicable for anybody in our seat that a good PE manager should be able to tap into as a source of return. And this is where you get to kind of what I call true alpha. So we don't control strategic decisions like replacing management as a PE owner would do. We're not involved in facilitating high value exits or sales, trying to time those at certain points in the cycle. We're not changing management incentives as a PE owner would do. and we're not focusing on rolling up companies or working on kind of inorganic growth through acquisition that you're going to get with PE. So all this really kind of boils down to control over a company's strategy, which is something we don't have. So that a good PE manager is probably going to have that as a source of true alpha, but to be clear, a lot of managers are not necessarily going to be PE managers are not necessarily going to be executing on all of these and checking all of these boxes. So we can go to the next slide here. Now, we've covered a lot of the what's contained in the text of this slide already. So I'll just be brief and just highlight the stylized impact of return smoothing in traditional PE. So for background, PE typically reports its returns quarterly and with a significant lag of 4 to 5 months or more, which means its reported returns are not subject to the vagaries of the public market on a day-to-day basis. And this return smoothing through far less marking to market of PE's portfolio companies is ultimately a critical driver of the appearance of diversification, the appearance of downside protection, and the appearance of lower volatility for private equity. Now, this comment is kind of for those of you who have a longer term focus and are more focused on the destination, ending up in the same place, and less focused on the short term kind of day-to-day aspects of the ride, where you can still end up in the same place with a different path. And that's kind of the goal in creating this buyout beta in the public markets. So next. So you've obviously heard my take so far. Some of you may be thinking that, of course, I'm biased in saying that buyout returns can be replicated because we're in the business of doing that. But definitely don't just take my word for it. There's been a growing body of research in recent years saying that PE returns can be matched with tailored public equity portfolios. And this research is being conducted in academic circles. I can tell you about professors at a number of universities. There's only one highlighted here, but I'd say there's scrutiny at a number of universities, a number of institutions that are invested in PE, sometimes very heavily, but want to make sure that they are being as smart as possible about the way they're allocating within their PE portfolio. So again, there's only one entity highlighted here in the middle. And for those who aren't familiar, GPIF is a Japanese pension. It's the largest pension fund in the world with over 1 trillion in assets. You can see their quote here that through a study that they conducted, found that the long-term performance of a replicating portfolio tracks very closely with the Cambridge Associates Global PE Index. And then beyond academics and beyond actual asset allocators, you have people on the sell side, for example, Deutsche Bank, where they have their research arm, which has conducted research into the exact same thing, and had a very similar finding that that you can generate returns that are very similar to private equity returns in the public markets. And I kind of skipped over the quote, the HBS quote, but maybe I'll just spend a second on that too, where one of the Harvard professors a few years back had found that the passive replicating strategy represents an economically large improvement in risk and liquidity adjusted returns over direct allocations to private equity funds. And he then, explicitly notes the average fees that you get all in when you look at the management fee plus the performance fee that you end up paying to these PE funds, that being over 6% per year. So next we can, on the next slide. Yep. So let's put this all together now. So how do we actually construct this buyout beta index? So first, it's a fully systematic approach to selecting companies that display PE type characteristics on both a top-down and bottom-up basis. So as I mentioned earlier, we start with the Russell 2500. We want to make sure that we're matching company size at the outset, and again, fishing in the right pond. And then from there, we tilt that universe towards industries that are favored by buyout managers. And that's evidenced by where PE managers are actually investing. So we have multiple data sets that will feed this. We know exactly where PE deals have been done historically, and we're going to tilt towards those industries in this index. And then from there, you're looking on more of a bottom-up basis, screening for stocks that match buyout criteria. So, I know we kind of we touched on some of the characteristics that PE finds attractive a few slides earlier. But as I said, a number of those are characteristics that can be easily found in public equities as well, public companies as well. So we're going to go out and look for those individual companies. And the way we approach this problem is rather than actually targeting, say, the most undervalued securities or the highest growth securities, what we do is actually take a screening process. We actually eliminate or remove from consideration the least attractive on each one of those metrics. So we remove the most overvalued tier of securities or the lowest growth tier of securities from our universe. Because at the end of the day, I think we feel pretty confident that, let's say in an example where a PE, where a buyout firm is going to look at the public markets for some public to private takeout targets, potential targets. And if, let's say, they have any kind of systematic screening process, we feel confident that these are the types of companies that would get screened out and basically never make their way into a buyout portfolio. And then ultimately, ultimately there's an index that's portfolio that's formed. That's what forms the index. Then you can have products structured directly off of that index, which is where Crane Shares comes in. So if we go on to the next, next slide, thank you. So this is a quick snapshot of the industry profile that you can expect in the index at this time. So the result here is an index with an industry profile that looks just like that of buyout funds. So maybe I'll point out a couple different main differences that you're going to get versus the public markets at this point in time. So there's going to be an overweight in tech and specifically software. PE tends to prefer recurring revenue models with subscription models that are very popular with SaaS companies, software as a service companies. Typically going to be underweight financials. A lot of that stemming from an underweight in banks that you're going to have versus the broader market in this index. Typically going to be underweight energy, tends to be a more cyclical sector. So PE doesn't tend to do as many deals there versus the broader market. Utilities tends to be an underweight. That's a more regulated industry or sector that PE tends to shy away from as well. And then real estate, and the main story there is just that this is kind of a separate arm or segment of private equity, not really a buyout place to play. So that gives you some idea of what's going to drive some of your, we'll call it more top-down active risk budget, if you will, or how this index is going to differ from a broader public equity index. So next we can go into the bottom-up aspect of the screens. I think you got a flavor for the top-down inputs and what ultimately drives a decent percentage of the returns of the index. Here we get into the bottom-up aspect, which is the series of screens that I mentioned. So maybe I'll just go in order here. I mentioned this, I alluded to a couple of these very quickly, but just to make it crystal clear, trying to avoid the names that we feel are obviously not PE type names. So when it comes to valuation, it's going to be the most expensive companies that are screened out of the index. Profitability, we're looking to screen out the least profitable companies. Cash management, the least efficient cash managers. For growth, it's the lowest growers that we're screening out. And I skipped over debt capacity. I want to come back to that one because that's one that sometimes catches people's attention. Here, the idea is because we know a company needs to be credit worthy or have the ability to take on debt in an actual buyout deal, traditional buyout deal, we're looking for clear evidence that these public names making it into the index can also take on debt. So in this case, we're actually just eliminating the names that have zero debt on their balance sheet. Again, not a known alpha factor, but we think it's important when you're thinking about the top-down exposures you're going to get with private equity. We want to make sure these companies can take on debt. So get rid of the least leveraged companies. Now that kind of takes care of the fundamental side of things. This is where you're just looking at the company characteristics. Some of this information could be sourced right off of financial statements. And then we're going to move to the right side, which we sometimes refer to as additional PE alpha proxies. And here, there are going to be various kind of inputs to each of these screens. But at a high level where you're looking at business uncertainty, you're trying to eliminate the most uncertain names, names that tend to be more cyclical, just not have as much predictability in those future revenues, future cash flows that you really need in a buyout deal in order to pay down that debt. Industry dynamics, I mentioned before, looking at the network of related companies. So here we have a number of negative trends that may be percolating within a company's network. You're trying to eliminate those least attractive, the names with the exposure to the most unattractive trends. And then informed investor is maybe one thing where we step out a little bit, the one signal where we step out a little bit from what traditional buyouts are looking for, and use our position as public market investors, and basically try to sidestep or remove any names that are have very negative sentiment around them. Maybe a situation is deteriorated for a whole industry or for a company, and there's a lot of short positioning or bearish options market activity or something making its way in. Basically, if PE wasn't locked into their holdings and they could react quickly to these deteriorating situations, we think they would. So because we can in a liquid portfolio like this, we figure let's make sure we're avoiding those really unattractive situations. So ultimately, that means we are leveraging kind of a key advantage we have, a responsiveness advantage that we have as public market investors, because public markets are dynamic and they do give you information. Not that we act on a daily basis. This is an index, but ultimately, it's an index that is reconstituted monthly. So there's an element of being able to respond. So next up, yeah. So a few different things to cover here. So maybe first is the endowment model has obviously become quite popular over the years, and endowments for many years now. I mean, there were some of the pioneers in using PE, and it's certainly evolved to the situation where PE is a cornerstone allocation for a lot of endowments. So for anyone who is looking to mimic that model, we like to think this index and any product structured off of it can serve as a core holding that provides a diversified exposure to the key return drivers of traditional buyout funds. And I think this also checks the box for anyone that has real liquidity needs or fee sensitivity that make traditional PE less than an ideal fit. And in addition, I mentioned this at the outset when I was talking about that, the public pension plan that we worked with in the early days. This is a way to rapidly gain exposure as an investor is building out or ramping up their strategic asset allocation to PE, which in many cases can take years, depending on where in the journey you are on ramping that allocation. And I think we've covered each of the bullet points at some point during my comments. So maybe we can skip to the next slide here. So this is kind of more of just a summary slide of what we've talked about here. We're obviously taking a multifaceted approach to creating an investable beta for buyouts. So we're again trying to target the actual drivers of buyout fund performance. We know there are other products out there that are more focused on providing exposure to, say, PE firms, the publicly listed PE firms that you're probably all aware of. I'd say we're trying to engineer more of a direct exposure to what actually drives PE returns at the end of the day. So it's not statistical replication. It's not those indirect exposures that I mentioned before. And then just a bit more background. As I mentioned, this index is still new. We're a little over a month old with the index, but that's built on a foundation of 6.5 years or so of a live liquid PE strategy. And that's ultimately built on a foundation of 35 plus years of experience in systematic investing at the numeric level within Man Group. And again, this is a fundamentally based, very disciplined, very systematic approach to identifying PE type companies and then putting them into a portfolio that ultimately can match a PE return over time, or has the ability to. Again, broad diversification across sectors. I know when I was talking about when I showed the sector chart before, I was really focused more on how the sectors differ from the broad benchmark. But I should have at the same time pointed out that there is broad diversification across those sectors and those industries and companies. So you're not taking on a lot of, this is not a very narrow index in terms of, the sector exposure you ultimately get from it. That's coupled with sophisticated risk management to make sure that you're not going to be overly loaded in any pocket of risk that may be percolating in the market. At least that's the intent with the risk controls. And again, just leveraging the data science and research capabilities and just broadly the infrastructure and resources that we have here at Man Group, as Kevin mentioned, very large investment manager, about 180 billion in assets spread across a number of strategies. Then ultimately, just the final bullet point here. I know we talked a little bit about different use cases, but one thing we didn't actually touch on, which is another benefit of traditional private equity, is just in a way, this index is in a way giving you automated vintage diversification, meaning when you go into traditional private equity, you kind of are tied to the vintage in which you invested, or at least in which your money was deployed in deals. And then you're kind of stuck and crossing your fingers that there is not a sharp sell-off in the market or some sharp, macroeconomic event that turns out to be a negative. Here, because this index is actually rebalancing on a monthly basis, you do have the ability to have the portfolio actually buy low on those opportunities. That's what we mean by automated vintage diversification here. So, but ultimately, I think hopefully it's become clear at this point, what we're looking to provide is really an exposure to PE return drivers, but without the PE fees and PE illiquidity. So ultimately just create the investable beta for buyouts. So that was, that concludes my my comments that I'd had, but maybe I'll kick it over to Kevin. I think he's been monitoring if there are any questions coming in. We actually have a couple wrap-up comments of his own as well.
Yeah, John, thank you. Great stuff. Great content. Very well done. We do have some questions coming in, but just to recap for folks that still want to ask questions, for those that we're live streaming on the website, send your questions to info@craneshares.com. And if you're accessing us through the Zoom link, submit via the Q&A button at the bottom of the screen. Great. Okay, a couple questions. This is from Brian, who wants to know, how often is the portfolio or the index constituents, the index turned over? And what drives those decisions as to the turnover? Is it, mimicking the fundamental decisions of PE managers? How often are we turning the portfolio over?
Yeah, so index is being reconstituted or rebalanced on a monthly basis here. And I'd say the thing that's more dynamic and actually responsive to what PE is doing is more the industry tilting part of the process. So over the course of each month, you will have new information on new deals that have been done in the traditional private equity space. Like I said, we subscribe to multiple data sets that are very real time in that regard. And so your industry profile will change a little bit in the index over time. We designed it to be a slower moving signal. There's a longer multi-year look back here. I'm happy to get into the details offline if people want, but multi-year look back so that, this is certainly not going to be changing in stripes month to month. But you do want to capture the fact that there are evolving preferences on the part of PE managers. So that's the part that'll change more. As far as the characteristics that we're looking for on more of a bottom-up basis, I think, we certainly are, we certainly monitor what PE is doing. We know, for example, that over time, PE's gone from, or buyouts specifically, have gone from more of a value bias in looking for names towards more of a growth bias. Some of that comes with the industry. Industry preferences evolving over time, starting to buy more of these SaaS, these software companies that tend to have growthier characteristics. We're certainly very mindful of changing preferences on more of a bottom-up basis, but I'd say month to month, you're not going to see changes in how the constituents make it into the index based on those bottom-up characteristics. There's more of an annual process where we can review that, and that's fully disclosed in the index calculation documents.
Okay, great.
Did I answer that?
I think you did. I think you did. A few other questions. Actually, we have multiple questions on the same topic. How often will buyouts occur in the fund? How often are the public holdings taken private? That's a question we get a lot. Maybe you can comment on that, John.
Sure, sure. So I can draw on the longer experience. I mentioned that there's we've had this strategy kind of underline the index for 6.5 years now, and we've had quite a few public to private takeouts in the from that strategy, which is great. I think it does kind of provide a fundamental check that we are, to use my term from before, we are fishing in the right pond. We are kind of identifying these firms that are PE like, because PE is coming in and actually buying them. And in some cases, PE firms will have, this is going beyond just the public to private takeouts, but PE will sometimes have partial stakes, not full ownership of public companies. We tend to find that we're co-invested in some of these names that are still publicly listed, but maybe majority owned by PE. So I guess there are a number of kind of fundamental checks that we are fishing in the right pond, in addition to just the ultimate goal of matching those returns over time. Yeah, so it's a pretty healthy number. Keeping in mind, so maybe there's a little bit of a side tangent, but some deals are going to be done in more micro cap indices or micro cap stocks. If it's a micro cap stock that doesn't fit the minimum kind of AUM, the minimum market cap to be in the Russell 2500 starting point, which is our universe, we will miss those. But I think anything in the small and mid cap space, it's going to be in our universe. It's going to be fair game.
Mm-hmm. Okay.
And that's where the majority of those deals are, I shouldn't say majority, but a very large number of those PE deals are going to be done in that space.
Right. Just want to be sensitive to time. We've got a bunch of questions coming in, which is great. There are some themes here. A couple of them are asking about the timing. Why are we doing this now? Why this product now? The concept of liquid PE seems to be a well-worn area. John, you talked about the academic underpinnings of the approach. Maybe you could comment or give your perspective on timing. Is it, PE hasn't done great relative to public markets of late, lack of exits. You want to comment on a little bit on that type of a question?
Sure. I think that can feed into, I guess recent environment PE maybe feeds into, why there seems to be a spotlight getting shown right now on liquid private equity, and why there seems to be a pretty healthy interest these days. But I'd say we weren't trying to be overly tactical in the timing of the index launch. Obviously, we've been running a strategy for a number of years now, so there's no real magic in the timing of the index launch, other than to say, I think the institutional use case is something that's been out there, for cash management vehicles. That's been out there for years. But what has changed in the time that we've been running that strategy that I mentioned is that PE, traditional private equity, has been very overt about viewing the wealth channel as kind of their next leg of growth over the next however many years, 5, 10 years and beyond. There's obviously a big market opportunity that they've identified. And I think what you're going to find is, or what we believe is that PE will kind of become more mainstream in wealth allocations, wealth client allocations. And to the extent not everybody can access it, at least top tier PE, we want to make sure that there is an alternative that's being offered that matches people's, like I said, fee sensitivity, matches their liquidity preferences, and so on.
Yeah, I think that's good. I think your comment about from the wealth space, there's been a dramatic increase in attention to alts in model portfolios. Dramatic increase at the platforms from single-digit exposures to double-digit exposures. I think having a tool like this available in the wealth arena, I think is very timely. Some investors won't put this in the alternatives bucket. Some put it, because of the correlation criteria in the equity side, but a healthy amount of users will. So I think that the trend is for liquid alternative type exposures, and this is clearly in that camp. So that's another tailwind that we think these, from a commercial perspective, having a product like this in the market, I think is timely for the current environment.
Yeah, to piggyback on that, I know there are a lot of headlines given to the kind of the democratization private markets. And we do believe that that's kind of a mega trend. It's here to stay, that it's only going to grow over time. And just like in traditional private markets, I mentioned very early on, there is an investable beta for basically all the traditional public markets. We feel that, that alternative should be offered, should be available as private markets make their way into the mainstream as well.
Sure, sure. Here's a technical question for you, John. This is from Steve. He asks, why is the least leveraged debt capacity an exclusion criteria rather than most leveraged? I'll let you take this one.
Yeah, it's a good question. We decided, with the whole series of bottom-up screens to just go with the exclusionary approach and focus on the most extreme kind of tail of each of these unattractive characteristics. Like debt capacity is definitely an interesting one. Knowing the debt levels that you get in traditional private equity, it would actually make sense to really try to target the most heavily levered companies in the public markets. But the reality is more leverage, especially when you start to get to those the extreme tails, is known to be a negative alpha in public markets. So I think more than anything, rather than targeting the exact level of leverage, we'd rather just take the approach of saying, okay, if this company has zero debt, they haven't demonstrated they can take on debt, because at some points it is prudent to actually take on debt if at certain points in the interest rate cycle and so on. So yeah, we more just want to say we know that PE companies need to be able to take on debt. We want to also invest in companies that have shown the ability to take on debt, and kind of acknowledge that our debt levels ultimately in the portfolio will be lower than what you get in traditional private equity.
Great. Here's another one we're getting. Do you view the product as a complement or a substitute for traditional private equity? It's a good question.
Yeah, that's always a good one. I think it's a little bit of both, to be honest. And it totally depends on use case. So in our experience, a number of large, sophisticated, traditional, I should say large, sophisticated institutional investors have been investing in private equity for many years. In a lot of those conversations, they're really looking at it as a cash management vehicle or something that's going to help make their PE allocation a bit more efficient, whether it's cost efficient or liquid. Whereas there are a number of investors out there that are not necessarily these, top 200 largest institutions in the world, that might have a different use case. In some cases, it is the reality that it's kind of top quartile PE managers that tend to outperform. There's a lot of academic research supporting that, and not everybody's going to have clear access to that top quartile of managers. So in some cases, it can be an alternative or a substitution use case, but it really does come down to individual investors and use case and their their risk preferences and fee tolerance and so on.
Right. Here's one more, John. Most, and I'm paraphrasing the question here. There are other liquid PE ETFs in the marketplace, and many of them. The question is, how does this differentiate from the ones that are in the marketplace? Most of them. This is my answer to the question. Please add on or change what I'm going to say here. Most of the liquid PE products in the marketplace invest in listed PE companies like KKR, Blackstone. This approach does not do that. You're actually buying the underlying companies as you described during the course of this conversation. Why one versus the other? Why is our approach, different, better? How would you describe the differentiation between this approach versus the listed PE approach?
Yeah. I think it's just the ultimate goal is different. So ultimately, for the ETFs that have the publicly listed private equity companies in the portfolio, it's just a different exposure you're getting. Ultimately, it's not completely unlinked. I mean, there is some linkage there, but ultimately, what you're going to get in that portfolio is an ETF that might trade a bit more like the financial services sector, to the extent that the Blackstones and KKRs that you mentioned, Apollos, are all going to be part of that sector, and not necessarily like the broader economy. They're a more diversified industry composition that you're going to get with an index like this. And ultimately, those companies, those individual PE firms' underlying portfolios aren't going to, those returns are going to differ quite a bit from what their stocks end up doing, especially in the case of these larger, more diversified PE players that are publicly listed. Whereas I think our approach is less of that indirect play, and it's directly trying to get at what is it if you're going to go invest, $1 in private equity funds and specifically buyout funds right now, what's ultimately going to drive your total return over the next X number of years? And then we're going to go out and try to mimic as many of those individual return drivers as we can. So it's more of a direct play on what, the beta, like we've said, or kind of what drives your ultimate return, your total return.
Great. Thank you. So I think we answered most of the questions. Thanks everybody for the questions. And John, thank you so much for the presentation. Very informative. With that, I think that wraps up the webinar for today. Again, there'll be a replay available on the website in a couple of days. And thanks again.
Yep. Thanks everyone for tuning in.